Did you know that some of the wealthiest people in the entire world make more money from a market crash than they do from the stock market consistently rising, like we've seen it do over almost the entire past decade? And in this video, I'm going to break down how they're making money in these bearish market conditions and how you can follow along and hopefully do the same. Over the past 11 months, we've seen SPY, the ETF for the S&P 500, fall from $479.98 down to a low of $348.11. That's a fall of a little over 27%, which if you compare that to the other market crashes that we've seen since the market has been created, we could actually see a lot more downside before we see things start to get better. The average market crash is about 47% from its peak, and it typically lasts around 21 months. Now the good news is that even though these bearish market conditions can be brutal for the inexperienced investor and trader, the recovery that follows these stock market crashes is typically much greater than the market crash itself. On average, following a major market crash, we've seen the stock market recover 155% from the low, and that recovery period is going to be on average about 56 months. So a 47% pullback from the peak, followed by a 155% rebound from the bottom, is what happens on average during a major market crash. Historically speaking, a major market crash has never been a bad time to start investing because the stock market has always been able to recover and has always been able to get back to the highs and even make new highs following a market crash. So that leads us to the question of whether or not this is a good time to start buying into the stock market, as we've already seen the market fall about 27% over the past 11 months. Unfortunately, the answer is not always as easy as yes or no, because there are so many different economical things that go into a stock market crash. One of the major things that we're of course dealing with right now in our economy that is a driving factor in this stock market crash is the inflation rate. Inflation is on the rise following the COVID-19 pandemic, and these high levels of inflation are also going to affect the way that people spend money in our economy, which are going to put a ton of pressure on these major companies in the S&P 500. Okay, so before we get into whether or not I think that this is a good time to start buying into some stocks, I want to go over some ways that you can actually make money right now, even as the stock market is in a downtrend. First and foremost, in order to profit from a stock market crash, it's very important to have cash. You cannot profit from a market rebound if you don't have cash prepared to invest during a market crash. Now that sounds pretty obvious, but typically speaking, most people are generally advised to not have too much cash on hand, because when you just have cash and you're not putting it at least in some kind of savings account, inflation is going to eat away at that money over time. So it's generally best to have your money invested in some way, shape, or form. However, if all of your money is tied up in these investments and these investments are going down lower and lower and lower during a market crash, sure, you'll be able to recoup a lot of those losses as the market starts to rebound, but you won't be able to buy into these deeply discounted stocks and actually make a profit from them going much higher in the future. So if you believe that the market is going to continue lower a bit further, it's always a good idea to get out of some of your existing positions, cut losses, and look to re-enter at a bigger discount to free up some of that cash that you have in those investments and to be able to make more money once the market starts to rebound. The next step in making money during a market crash is to look to invest into stocks or sectors of the stock market that are actually outperforming the general market, meaning that, in other words, look for stocks or sectors that are going up when the rest of the market is going down. Now, if we take this heat map, for example, we could see all of the different performances of different sectors and even different individual stocks in the market. This is the one-day performance. However, if we go to the year-to-date performance, this is going to show us how these sectors and stocks performed since the beginning of the year. We could see that these huge companies like Microsoft, for example, down 30%, Nvidia down 54%, Google down 34%, Amazon down 38%. However, there is actually one sector of the stock market that has been consistently outperforming the rest of the market in the entire year of 2022, and that is going to be the energy sector. We can see XOM, for example, is up 81% for the year, CVX is up 54%, COP up 79%, and so on and so forth. And this is something that we will consistently see during a market crash. There's always going to be one or two sectors that are going to consistently outperform the rest of the market. In this case, it does happen to be energy because we saw oil prices spike significantly once a lot of the issues from the COVID-19 pandemic started to fade away. One sector of the market that consistently tends to outperform a market crash or bearish market conditions in general is going to be the healthcare sector. Now, this is not going to be 100% true. Obviously, the healthcare sector has pullbacks and has bearish conditions every once in a while as well. But the thought process here is that even as the stock market is falling, even as a recession starts to ignite, whatever it may be, there is always going to be a need for healthcare. There are always going to be people getting sick and people needing treatment. And because of that, stocks in the healthcare sector tend to pretty consistently outperform during bearish market conditions. The next way to make money during a stock market crash is to look to short sell and to buy puts if you're an options trader. Short selling and put options are two ways to actually make money as a stock goes down. Yes, believe it or not, if you are new to investing or trading, the market doesn't need to just go straight up in order for you to make money, because short selling and put options actually become more and more profitable as the price goes lower and lower. And the idea for this is very simple. Don't fight the trend is your friend. As the stock market is in a consistent uptrend, it doesn't make a whole lot of sense for us to try to short sell into that uptrend, which would be, of course, fighting the trend. The same thing is true when a stock is in a downtrend. The stock market is currently in a downtrend, so it doesn't make a ton of sense for us to try to buy at the exact bottom when we can instead look to ride that downward momentum by short selling stocks and by buying put options, which again are going to become more and more profitable as the price goes lower and lower. So let's take PayPal for example. About a year ago, we saw PayPal hit a high of $233.55, and just recently we saw it get down to a low of just $67.58. Currently, it is trading at about $85 per share, which is about 63% below the peak that it hit not even a year ago. So by taking advantage of this downward momentum, and if you were to perfectly short sell up at the $233.55 high, and cover your short position today at the current price of $85.65, that means that you would have made a 63% profit as opposed to taking a 63% loss as someone that is invested in this downtrending stock. Now, obviously, it's safe to assume that you wouldn't have short sold all the way at the exact top, but once PayPal started to establish a downtrend and you start to see the overall stock market become more and more bearish, and you start to see all of these different issues in the economy come to life, there was plenty of room to profit from short selling and by buying puts in PayPal and with tons of other stocks with very similar charts. So now back to the question of whether or not this is a good time to start buying into some stocks in order to profit and reap the benefits of the market crash turning into a market recovery. Now, if we just do some quick basic technical analysis here on SPY, the ETF for the S&P 500, we can see that SPY is in a bit of a downtrending price channel just by connecting these highs here and by connecting these lows down here. We could see that just about every time the price gets down to the low of this price channel, it bounces off of it, and every time that it reaches this resistance level up at the top, it pulls back. So in terms of buying into some shares here in the general market, at the current price here of about $384 per share, this would not be the best risk and reward setup because we're currently trading at about the middle of this price channel, meaning that it's about 50-50 of whether or not it goes higher or lower, just based on very basic technical analysis. Instead, in order to kind of help set yourself up for success and get yourself better risk and reward on this investment, you would want to wait for it to pull back a little bit closer to that level of support at the bottom of this price channel, and maybe then start to scale into a position. And that leads me to a very important topic of scaling in and out of trades and scaling in and out of investments, which is a much better way of going about it as opposed to buying all into your position at one time. If you think about it, you're pretty much setting yourself up for a loss on the investment if you're buying all in at once and if you're using proper risk management while the stock is still in a downtrend. You're most likely going to hit your maximum loss or your risk level before you ever see the stock start to recover and bounce back up. And because of that, if your maximum position size is maybe 500 shares, for example, I highly recommend instead of doing that, you look to scale into a position slowly, maybe buying 100 shares at a time. So if SPY starts to pull back down to the bottom of this price channel, where we have some support to base our entry off of, maybe start to buy 100 shares, see how it reacts to that level, buy another 100 shares. If it starts to bounce back up, you could add a few hundred more shares. And by doing this, slowly getting into this position, you're going to be able to slowly average into your position at the best prices, and it should be very profitable for you once we see the stock market finally start to recover. And if you decide to go about your investment in that way, I do believe it is just about time to start scaling into some long-term positions, because after all, there is a ton of fear in the market at the moment, and Warren Buffett himself said to be greedy when others are fearful and fearful when others are greedy. Anyway, if you enjoyed this video, please make sure to give it a like and subscribe to the channel. And if you want to learn more about day trading, swing trading, and long-term investing, and join us in our daily trading group, make sure to check out my website, Master the Market, which will be linked down below in the description. Anyway, thanks again for watching. I hope you enjoyed, and good luck with your trading and your investing.